Happy Thursday, everyone. Thank you for joining us for this month's Market Pulse webinar. As we do every month, we will give everyone 30, 45 seconds to get signed in. We did have a pretty large sampling of folks in the waiting room, so we appreciate those that join early. If you're one of them that have joined and can hear me, we have on our first slide today, as we do every month, just a couple of QR codes where you can actually sign yourself up for our daily newsletter called the CRE Rundown. Comes out every morning, Monday through Friday. Tracks the transaction market, gives a big picture lead in, something topical, and then gives you some transaction stories. You get that delivered to your inbox every day just by clicking the QR code. And then also, if you haven't checked out the podcast, we'd love for you to click on the QR code there and you can subscribe to our podcast, which is now over 2 million listens and we'll be at 350 episodes next week. We just recorded the 349th episode this morning. So we're excited to cross over into the 350 threshold here this next week. So looks like we've leveled off on people attending so far. So we'll go ahead and get started without any further ado. So as we mentioned, we appreciate you joining us. This is our monthly Market Pulse webinar. We've been doing this now for several years. We track the entire universe of commercial real estate lending through our data and platforms. We have about 4 million properties in our data set. We've been doing this now for 33 months. Almost 20,000 registrants have signed up for the Market Pulse webinar. We really appreciate you carving out some time and spending it with us today. So today it'll be myself, Lonnie Hendry, the Chief Product Officer at Trepp and co-host of the Trepwire podcast with my colleagues Tom Taylor and Rachel Szymanski, our Chief Economist and Senior Research Manager. Pretty much our typical crew for the Market Pulse webinar. So for this month's edition, we have a lot to cover, so we're going to try to hit the ground running. We're going to look at the office line item financials report and some insights that we've gleaned from that. We'll be pushing out a formal report on this here shortly. It'll be similar to what we put out recently on the multifamily side, where we look at some of the line item financial expense growth predominantly, but we also look at things like revenue over a 10-year horizon, going back 10 years, expenses and NOI, compounded annual growth rates, et cetera. We'll do a deep dive on that. We have a continuation of Rachel's discussion last month on the maturity distress resolution. Last month she covered the maturity drag, and this month we're going to get into how things have either resolved or not resolved and kind of some metrics around that. And then we're going to give you some perspective on multifamily rents and markets that are high growth and don't have the burden of rent control in those locations. So kind of free market perspective of how supply and demand impacts rental rate growth or decline. And then we'll do a deep dive on the lodging CapEx analysis. We put out a blog on this about a week or so ago where we look at divergence of CapEx spending in the hotel sector post-COVID. So we'll kick this off every month as we do with our headline rundown, just to kind of give some perspective of what we see making headlines across the CRE landscape for the month of August. So, Tom, if you don't mind, take us out and maybe highlight a couple of these that caught your attention this month.
Absolutely, Lonnie. Thanks for the lead in. And, you know, usually in the month of August, you see a relative slowdown in the world of, financial capital markets as lots of folks are on vacation. A lot of the news over the past month have been kind of recaps, taking stock of what happened in the first half of the year as we, look toward the finish line. A couple of highlights that I found that were kind of in our major outlets over the last month were recaps about multifamily sales that I found very interesting. Obviously, there's been it's been a big year for SASB transactions and CMBS issuance driven largely by trophy properties. We've seen, however, across small cap and large cap multifamily, sales are up. A lot of folks trying to get into those properties at a good basis. Something that I found interesting too is the AI frenzy, the particularly CapEx spend on data centers and rows of servers essentially accounted for almost all of the GDP growth that's occurred in the United States this year. Where you can debate whether or not the economy is slowing down broadly. But I've seen some very interesting analyses, including this story here, which shows that the AI CapEx spend is largely responsible for a lot of the growth we've seen in financial markets and in GDP. And then the last thing I wanted to mention was a bright spot here in the bottom left corner. Detroit, a city that has gone through some serious economic turmoil coming out of the GFC when several large automakers and large employers in the area needed bailouts from the government. We've seen a lot of great development, and this was a really great recap in the New York Times about the growth that Detroit has seen.
Yeah, so Detroit's interesting. I'm going to be at the annual Counselors of Real Estate conference here at the end of September. It's actually hosted in Detroit this year, and Dan Gilbert, who owns the Cleveland Cavaliers, his firm has done an extensive amount of renovations in downtown Detroit. I mean, pretty remarkable renaissance for the urban built environment there. So I'm excited to get to Detroit. If anyone's going to be there, pardon me, I'd love to connect and say hello. One other thing that was interesting on the headlines for me, Tom, was that Dallas, the city of Dallas, has offered
How do you
some
like that?
incentives for Scotiabank to try to come to what they're calling Y'all Street now. So they've basically offered about $5 million worth of incentives in the form of tax abatements and other things if they bring 1,000 jobs with an average annual salary of 135,000 is kind of the trade-off there. So we'll see if they can get them to relocate their U.S. headquarters to the Dallas area. There's been a lot of activity on Y'all Street. If you haven't heard about that, you should check it out online. It's pretty interesting with just the financial sector moves happening in Dallas to kind of combat some of the stuff that we see in New York and Wall Street. So kind of a funny play on words there. So let's keep moving here. Rachel, each month you give us a nice update on the macro, and this month is no exception. So give us some perspective around labor, trade, and inflation and what it means for CRE.
So on the labor front, we're continuing to see some slight cooling. There's been a slight uptick in unemployment. And I think one of the things that made it the headlines was that there is a surprising revision to the jobs report where they made some downwards revisions to May and June job growth, and it was fairly large. This can happen because these reports use partial data and form estimates, and the official numbers take time. But these revisions were quite unusual. We've also seen on the labor front some layoff announcements from companies, so that further adds to this sense of cooling. Then on the trade front, there have been some announcements for additional tariffs, and we've also seen that tariffs have been having an impact on the construction industry. Several measures of things like project delays and project abandonments, new construction, it all points to tariffs having a negative effect on the construction industry, which filters into CRE because of development pipelines and transaction volumes and such. And then on the inflation front, there has been some difference between PPI and CPI. We've seen some uptick in PPI. CPI is held more or less steady. But from major retailer earnings, we're seeing on retail front that a lot of companies are putting the tariffs into their margins rather than increasing prices. So I think this points to we might be seeing some sense of a delayed impact of tariffs on inflation. So for commercial real estate specifically, potentially future economic softness could mean things like lower demand and rents, maybe higher credit risk. And I think something also to keep in mind is be wary of expense inflation. So from the tariffs, you might be seeing inflation in the cost of renovation, also the cost of insurance due to inflation in replacement costs. And then as we went in last week or last month, we've also been seeing some inflation in property taxes. So this expense side is something to keep in mind.
Yeah, so
Going to the
that's
next slide. Oh, go
I
ahead.
was going to say, Rachel, that's an interesting perspective. We saw that pretty pronounced in the multifamily space. I think what we'll see in the office space with the data today that it's not as pronounced. I think maybe more in the tenant improvement line item, but in terms of taxes and insurance, still elevated, but not to the same level as the multifamily. I did want to ask a couple of questions on the labor market. You know, Jerome Powell was in Jackson Hole this last week, and it felt like he left the door open for a rate cut in September. He cited softening in the labor market. What are your thoughts on kind of his commentary and some of the talk track that maybe has shifted slightly given, you know, some of these challenges that you talked about here on the overview?
So there's a tough decision. Softening in the labor markets could pave the way for a rate cut, but I think inflation is still above the Fed's 2% target. So in my opinion, if I were the Fed, I would continue to wait. But I think it's going to be a difficult decision and it could go either way. But on the next slide, I actually have a bit more commentary on monetary policy. So we have been seeing some political volatility with the executive branch involvement in Fed hiring decisions. But I think something that maybe has slipped under the radar, given all the political volatility in the headlines, is that the Fed just underwent its 5-year review of its monetary policy framework. And this initially came out, the first one came out in 2012, and they did one update in 2020. And in this 2020 update, they put in 2 features called flexible average inflation targeting. And they also said that they would respond to shortfalls in maximum employment, but not to going above it. And then in this 2025 review, they rolled back those 2 features. So I think rolling back these 2 features made the Fed's official stance a little bit more hawkish on monetary policy. But again, they'll review the data and then they'll make a decision based on the data. But I think that's important to keep in mind. And then with a good amount of this political volatility and also movements on the labor front and inflation front, this has been reflected in the yield curve. So we've seen that the short end has become lower in the last month, and the long end in the past couple of weeks has tilted higher. So I think this, on the short end, this particularly reflects expectations of a rate cut in the near future. And on the long end, I think this could reflect some longer term inflation expectations. So I think this difference between the long end and the short end is important for commercial real estate, because for commercial real estate, you tend to borrow more long term. So I think it's important to keep in mind that even if we do see rate cuts, it might not necessarily translate to the long end. So that'll impact your borrowing costs.
Yeah, we saw this in 2024 when the Fed lowered rates 100 basis points and the 10-year went up and borrowing costs did not come down for commercial real estate investors. So I think that's probably what happens here is you see a 25 basis point rate cut, but it doesn't materially impact borrowing cost for commercial real estate borrowers. We'll see what happens. You know, it's an interesting time frame right now, just with the administration, all of the headwinds that the Fed has run into with the political motivations. They're kind of in a really tough spot because if they don't lower rates, they're going to continue to see major pushback. If they do, even if they think the data supports it, people are going to think it's politically motivated. And so it's a challenging place to be in. Just one question before we move forward. If the framework, you know, which I do agree with you, has been somewhat muted relative to some of the other headlines. If there's a new Fed chair when Powell leaves, is the framework going to be in place because it's a 5-year review, so it's not subject to a new chair's interpretation, or do they have some latitude relative to some of the things you mentioned today?
So the framework is in place. They don't have latitude to change that, but I think they do have some latitude in the interpretation. So something that a lot of economists have been noting is that they don't do a very good job of defining exactly what they mean by maximum employment. So I think there is some wiggle room depending on your specific Fed chair's stance on monetary policy.
Yeah, thank you. Thank you for that feedback. And it's interesting. We talked on the podcast this week. The GDP report that came out last week was like 3.3%. It was really strong. So you have all these conflicting, you know, potential labor softening, but GDP is still really, really strong. Retail sales were up. A lot of individual retailers actually, you know, increased their outlook for full year stuff in 2025 based on the last report. So we have all these conflicting challenges in the market playing themselves out. Consumer sentiment was down in the month of August. So you could take a position on either side of the equation and pretty well support your position. That's why we love what we do. We'll be reporting on this stuff real time as it happens on these monthly webinars. So Tom, I wanted to kind of transition us here into the office operating statement framework. So for those that were on last month, we did a very similar review for multifamily where we looked at total revenue, OpEx, and NOI per square foot on a 10-year horizon. We've effectively done the same analysis that we did for multifamily across the office sector. And I gotta say, I'm gonna let you you know, walk us through the numbers here, Tom, but the numbers were definitely much more muted in the office sector relative to multifamily. What were your takeaways?
Yeah, I think that was a great lead in, Lonnie, too, because, job growth, or if there were to be more softness in the labor market, does affect demand for office space, right? The white collar employers are cutting jobs and they probably don't need as many square feet of office space, and that would have a negative impact on top line revenue. However, for the last decade, according to our data, income growth has more or less risen in line with inflation. On a per square foot basis, we looked at total revenue, total expenses, and net operating income. And this is across all, securitized office properties in our data set. Office revenues grew steadily. I mean, our general rule for inflation across the broad economy is about 3%. So we've been considering a lot of whether these line items are increasing above or below that threshold. It's very interesting that office revenues pretty much grew in line with inflation, and that's in line with a lot of step ups within leases. Usually, office tenants will sign longer term leases, and built within those contracts are increases within the term. So across the board, this is a very large data set that took quite a while to parse. It was very interesting to see these lines be much flatter, like you said, than the multifamily space. What I thought was interesting and the most notable part of this particular chart that summarizes the entire operating statement is in the last several years, margins began to compress, as one would expect. And going from 62%, revenue out of NOI, so about 38% of your NOI being expenses, to a larger portion of expenses as a portion of net operating income, so margins compressing, is maybe less than one might expect. It does show some pressure, especially heading into a lot of the leases that were signed in the pre-COVID paradigm coming up for renewal, and a lot of office tenants probably not renewing at the same levels of space that they were previously. But the story here, as we'll get into a bit more later, is mostly that the operating income has been relatively consistent. And then all the factors affecting office seem to be kind of broader and about valuation and perception in the marketplace.
Yeah, I think the key takeaway for me you mentioned was just the lease structure on office relative to multifamily. Multifamily turns a certain percentage of their property over every month because typical leases are 12 months in term. Whereas in an office building, if you have a 10-year term across 40% of your building, maybe 7 and 5 on some other subsets of the tenancy, it's just much slower turnover. Maybe a heavier concentration in some years. We see that obviously, but to your point, I think some of the flatness here is just this stability that's provided by a multi-tenant staggered lease term type of asset, which quite honestly, you could argue has been the saving grace for office post-COVID. If they had shorter term leases, the demise of office would have been significantly more hard felt. The fact that tenants still had to pay rent because they were obligated per a lease, even if they weren't using the space, has really buoyed, I think, the sector as a whole. So this is a much more granular look at line items. Again, still looking at the compounded annual growth rate over the 10-year period, but now we've broken it out instead of just looking at total OpEx to give us a perspective of what each individual line item looks like. So give us some of the takeaways here, Tom.
Good thing. And, again, managing a commercial property is a very local business, but we're trying to find broad trends throughout the country. And one continuation from the last segment that we did on multifamily expenses was the very, very large growth that occurred in multifamily property insurance. For office, insurance still outpaced every other line item financial expense by quite a bit, and definitely outpaced inflation, but not quite to the severity. Multifamily compound annual growth over the last decade for insurance was almost 12%, 11.77. Office still at 7.5% is substantial, meaning it's getting more expensive to insure these properties. But one part of that is the way insurance prices are calculated is partially as a result of the value or replacement cost of the building. So if office properties are being reassessed at lower values, that means the insurance expense might end up being less, even if there's increased risk from natural disasters and losses and things like that across insurers' portfolios. So that is obviously the kind of headline here. Only a couple of the expenses outpaced inflation, or that kind of 3% threshold we've been talking about, professional fees, so lawyers, accountants, things like that, and repairs and maintenance, which really wasn't that much above it. And the other most interesting part of the growth rates, from my perspective, is the retreat of utilities. And we were trying to kind of sort through what exactly this means, that utilities actually decreased on an annual basis going back over the last decade. And what we, I think, have arrived at in a couple of ways is that, energy efficiency has increased at a lot of office buildings by mandate here in New York City. There's been a lot of local laws passed to mandate energy efficiency and carbon neutrality, and that appears to be being implemented, as well as lower utilization. Utilities is obviously a variable expense at a certain point for things like water and heat and light. So if you have lower occupancy, you may be spending less on utilities, which is, I suppose, somewhat of a silver lining.
Yeah, it's interesting to see utilities be negative. We did not have any negative on the multifamily side. And to your point, insurance in multi was over 11% compounded, and we're at 7.5 here. Still significant. I still think this is a topic that's probably not being discussed at a level that it should be nationally. I mean, that's a significant increase in that individual expense. And I don't know from an owner's perspective that there's really a way to mitigate against this. I mean, that's the one thing that's challenging. Like your management fees, your payroll, you can, you know, do some things to mitigate some of those expenses through personnel or strategy, but on insurance, you're kind of at the whim of the market. And unfortunately, it seems like the first two property sectors we've looked at, there's not been a whole lot of relief or opportunity for relief in the insurance space. So let's transition here. We're looking, now at the two insurance and taxes kind of pulled out from the group. And I know taxes were one that caught your attention. And before we move on, Tom, I wanted to say I skipped a few housekeeping things. You would think by month 33 I would know how to do this. If you have a question, use the Q&A function. We'll do our best to answer those real time. And we're going to have a survey at the end. If you don't mind filling out the survey, that would be great. And also, we're going to send a copy of the video and the slides to everybody that's in attendance today. So I apologize for not getting that out in the first couple of slides, but we will answer your questions if you submit them, and we will send the video out, and we'd love for you to take our survey. So back to regularly scheduled programming. Tom, tell us a little bit about the taxes and insurance for this sector.
Yeah, absolutely. I think you've zeroed in on exactly what I think are the most interesting parts of this data set that we recently had completed. You mentioned property insurance has functionally doubled over the last decade. Obviously it wasn't quite as severe, so maybe we were anchored a bit higher in our expectations after the multifamily report. But this is still substantial, and it still has the potential to change underwriting assumptions in a lot of deals. As a lot of debt investors, a lot of equity investors are going to sharpen their pencils as they're looking at office deals. And what assumptions are they going to put in for these expenses and for their growth rates? And so I think that causes a lot of folks to take a pause and really examine the data that are feeding their assumptions. And then you're exactly right, Lonnie, too, that, I mean, these two fixed expenses, meaning that ones that are not variable or controllable at all, really by the operator, they're also usually the largest parts of the budget, and real estate taxes can be a very serious one. And later in this presentation, we pick apart a few more filters, ways to look at the impact of real estate taxes. But let's suffice it to say that there are certain categories of office properties that are feeling the squeeze more than others.
Yeah, we'll talk more about that as we get to that part of the presentation. One interesting thing on the taxes, though, is in almost every jurisdiction, you do have the right to appeal and try to get those lowered versus the insurance, where maybe there's less remedy available. Still have to jump through some hoops on the tax side, but at least there are some optionality for potentially getting them reduced. Let's look here at the squeeze that we're seeing for our urban office owners. You've broken this out. We did the analysis leading up to this was effectively office nationally. Now we're breaking it out by office type, suburban, urban, and medical. What are your takeaways here? We also have government as well.
We do. Yeah, these are all the property subtypes that we're looking at, the major types of tenants and locations, right? So urban office is going to be, generally speaking, your CBD, your central business district office. Given that we are currently in Manhattan, most of that is a central business district by the definition that separates the categories. Suburban office is going to be a lot of kind of lower story buildings, places like Westchester County, New York, or Orange County, California, the outskirts of cities like Dallas and Houston. And generally speaking, what we've seen is suburban offices, obviously, as one would expect, command lower rents in general. And so therefore the operating income per square foot is generally lower. Those have moved in a generally similar pattern over the course of the last decade. What was an outlier when we looked at these subtypes was medical office. And we mentioned the duration of revenue earlier, right? So office tenants, generally speaking, have longer durations of leases, meaning that economic shocks have more time before they actually take effect on the revenue being charged and collected by a lot of office property owners. And the margins and expenses and stickiness of those tenants is also a part of that. Medical office has had very sustained duration and demand. There's been some cuts to government funding of things like research facilities, but offices for doctors, offices for outpatient facilities have not seen any meaningful reduction. So they've been generating more income on a per square foot basis than any other subtype, and that's only been growing and at a nearly 10% annual clip going back for the last decade. I thought that was very impressive.
Yeah, it's interesting. You've got a lot of people that work in the office space that specialize in medical that would argue post-COVID, it's its own class of property type. A medical office has performed significantly better than broad office for various reasons. And it's interesting because a lot of them are now backfilling what used to be retail spaces and converting them into medical offices. It makes sense based on a visibility, access, parking, all of those things, and some retail centers. You've seen a pretty prolific growth in the medical office space there. So let's transition here. Now you're looking at the comment you were talking about earlier, Tom, of just how large of a line item expense real estate taxes are as a percentage of revenue by the different subtypes.
Yeah, exactly, Lonnie. And we started off this session talking about why an employer like Scotiabank might be attracted to bring jobs to Dallas. One of those is the reduction in state income tax, right? Coming from a place like a high tax place like New York, or just generally speaking, and being in a very large city, you're going to pay a larger portion of your personal income tax to the government. Now, when considering the different office types, there's also obviously property taxes assessed by municipalities. The proportion of revenue that is being paid to real estate tax, if we look at the 2015 to 2022 period, was pretty flat for most office subtypes. But then in 2022, all of a sudden you saw, perhaps again, due to effects both on the numerator and the denominator, an increase in the proportion of revenue being collected by urban offices, again, those in central business districts, being paid towards taxes. And 330 basis points is a fairly significant jump. Again, we saw earlier that urban office NOI really didn't take that much of a plunge. So we can attribute this, I think, primarily to an increase in taxes being collected by these cities. And that's for many reasons. A lot of budgets are under pressure, and municipal governments need to find sources of revenue. But the urban office obviously faces a lot of macro headwinds, and one of them appears to be increasingly the real estate tax burden, which again you said you can challenge in court. I've not seen a lot of successful cases of that personally, but I'm sure they exist.
Oh yeah, no, there's an entire industry where people are very successful at appealing the taxes. And I think depending on states and the frequency in which taxes are assessed, it varies, but you have some states that are annual reassessment, and there's an entire machine built to go through and do the appeals, and they're very successful at that. I also think some of the challenge here is just, in some of these offices that have seen vacancy increase, potentially revenues have come down slightly, and you're seeing a larger percentage of that revenue being spent on taxes. But this is something we'll definitely keep an eye on. I mean, taxes were one of the larger line item increases on the multifamily side. And so, I think this trends with what we saw on multi as well. So let's transition again, kind of same topic, but now instead of just looking at national across those two line items, or in this case, the taxes specifically, we're now breaking it out by MSA. So, and we're not going back 10 years on this. We're basically going back 3 years. But give me the talk track here, Tom.
Exactly, Donnie. So this is an important thing. This is not the percentage of a municipal budget that comes from property taxes. That is another measure that I think is also very interesting. But this is again the percentage of revenue in a given MSA for office properties and urban office properties that goes towards taxes. And in a very strained municipal budget city like Chicago, we see a large and an increasing percentage of revenue being allocated to real estate taxes. Interesting here, in between the first and second or third largest city in the country is Hartford, which is known for being home to a lot of life insurers. So you can see how over the course of the last several decades, that city may have built its economy and its city budget around these large and stable employers in their urban office center. Otherwise you see a few cities with large jumps like Louisville. Louisville seems to, be trying to find sources of revenue however they can. And then, one of the other most interesting office markets I think around right now is Washington, D.C. We're actually looking at doing a story on Washington, D.C.'s office tax practices in tomorrow's rundown. It's a sneak preview. And we've seen relatively flat growth over the last several years there, but it's still a relatively high proportion compared to the rest of the national average.
The DC office market is really incredible. I thought with Doge and all the stuff that garnered headlines around that, when they first kicked that off, that we were going to see a very swift demise of the office property sector in DC. And to my surprise, it's been incredibly resilient, at least to date. We'll see if it continues to maintain its ability to hold out, but there hasn't been the steep drop off. In fact, DC from an origination perspective was top five last quarter originations in office. So there's still a fairly strong appetite for office lending in DC on a relative basis. Okay, so let's move on to our next slide here. So this is looking at, we've looked at rents, we've looked at, the expenses. Now let's talk a little bit about what cap rate deltas look like between conduit and SASB. And maybe, Tom, if you'll take just a second and give some perspective on the difference between conduit and single asset, single borrower, and why we've kind of pulled them apart here, specifically for the office sector.
Of course. So the basic difference for those who are not, CMBS junkies like we are, between a conduit and a SASB deal are, conduit pools are an aggregation of usually 50 to 100 commercial real estate loans. It can be, various geographies, various property types pooled into a deal that are then sliced up and sold as bonds. So this has more, diversification. It's very interesting to look at the composition of those conduit pools and find out what managers and issuers find that the market wants to buy and wants to have exposure to. But generally speaking, you're going to have more of a diversity of office class per se. You see higher proportions of suburban office and Class B and C office spread throughout the country in conduit pools. So it makes sense that that would have a higher average or wider average cap rate than single asset, single borrower, which conversely tend to be trophy offices. So a SASB deal, single asset, single borrower, as in the name, can either be a single asset like Rockefeller Center, in which we're sitting, or it can be a single borrower that is, the sponsor for a pool, a portfolio of loans and properties. But in the office, what you often find is major either Manhattan skyscrapers or skyscrapers and things like that, trophy office properties and other major metros that back a single deal. And so what we tried to achieve here was kind of an understanding of where trophy offices are priced at versus maybe your average office is priced at. And a cap rate, and again, I assume most of our joiners will know this, but it's worth explaining, is basically the inverse of an earnings multiple, right? So it's the value and it's the multiple of NOI into value. So a lower cap rate means that the valuation is a higher multiple of current operating income. And the way we back into our cap rates is we take, at the time of securitization, the appraised value and the underwritten NOI. And so what we see with cap rates moving up is that the perceived value of future earnings at that property is decreasing, right? Because a lower cap rate means a higher multiple. So if we see a higher cap rate for conduits than SASBs, we can infer that the conduit and the regular offices are being valued at a lower perceived multiple than the trophy properties. Now, what's interesting is that the delta has kind of compressed over the last several years. And, while we saw in some of our other slides that NOI between the trophy and the regular offices has actually gotten closer together, meaning that there's not much of a NOI premium for trophy offices on a per square foot basis, the cap rates have gotten wider. So the flight to quality is very real as investors try to pile into very, very safe, very, very sure thing investments.
Yeah, so I think for our audience here, if you see these cap rates in your local market, you may say, there's no way we're getting a suburban office deal done at sub 8 cap rate, and you may be correct in that instance. I want to caveat the cap rates here saying these are factual cap rates, but they're on deals that were recently financed or refinanced. So these by definition are the types of offices that lenders are willing to do deals on. And I would suggest that today that's still a small subset of the overall office marketplace. There are a lot of offices, and Rachel's going to talk about this in her upcoming slides, where there's a lot of property types, office being one of them, where there's a huge subset of the population where lenders don't know what to do with them. They're really not refinanceable given their in-place interest rates and their in-place value relative to what they would have to reset to from a loan sizing perspective in today's market and today's cost of capital. So I wouldn't be shocked if you see deals in your local market on Class B suburban office at 10 plus cap rates to get deals done. I think that there's a large sample of those taking place in the market. This is more indicative, and on the SASB stuff, we've had a significant amount of issuance. There's been about 20 plus billion worth of office origination year to date in 2025. About 13 plus billion of that 20 has come from New York. And really, it's come from, a couple dozen buildings that are super high end, highly amenitized, best tenant roster type of stuff, which by definition is going to have just a much lower cap rate. The perceived risk and so forth is going to be significantly less than some of the others. So let's transition. We have our maturity drag and resolution outcomes. So Rachel did a deep dive last month on the maturity drag in commercial real estate, and she put a really nice report together that talked about the 23 billion worth of loans that are stalling past their maturity dates. It was actually picked up by Bloomberg. We had a nice write up in there. You can access the first report by using the QR code on the left. Stephen Bushbaum on our research team also put together a new report called Over the Commercial Real Estate Maturity Wall: Who Paid, Who Didn't, and What Followed. This is the second report, and Rachel's going to do a little bit of a deep dive into that report today as well. You can access that report by clicking on the QR code on the right-hand side of the slide here. So both of these are very complementary of each other, and they do provide some really good context of just kind of where we're at relative to, this perpetual maturity wall that we kind of see ourselves facing. So Rachel, maybe you can just take us out here, highlight the charts, tell us which report they apply to, and give some perspective for the audience today.
So last month we were talking about maturity drag. So a lot of these loans that are just going past the maturity date, not getting resolved. And we were thinking about, why is this happening? So this left chart was showing that mostly retail drove the trend post-pandemic, and then recently office is starting to drive this trend of loans lingering past the maturity. And but looking at just volume, we could just be seeing more maturities in either retail or office. So in this next report, what we did is break down what is the share within each property type that failed to pay off. And we see a similar trend where retail and office continue to have the highest, not only volume, but also share of loans that fail to pay off.
I think it's interesting on the retail side, just not to cut you off there, Rachel, but we do need a caveat on the retail side that there is a large proportion of that that's tied to the regional and super regional malls that are somewhat legacy. So retail usually jumps off the page on some of these, but some of that is tied to just some of the legacy deals that were done for regional and super regional malls. So sorry about that. You can take back over.
And so if we look a little bit more deeply at some characteristics of loans that fail to pay off, we find that the ones that fail to pay off tend to have lower DSCR and lower debt yield. And this is pretty consistent across property types. So if you look at these left two columns and also the right two columns, we see pretty much across the board that the ones that are failing to pay off just have poor fundamentals. But if you look at the gap in the fundamentals between paying off and not paying off, it looks like debt yield, there's a larger difference between paying off and not paying off. So it looks like from the data, debt yield is becoming more of the decisive screen for whether a loan will pay off or not. So this is indicative of lenders taking into account the more long-term repayment capacity of the loans rather than just interest coverage. And this makes a lot of sense in the current macro environment, given the high interest rates and the macro uncertainty regarding interest rate policy. So if we look a little bit more deeply at what happens after maturity, So we see that there are some differences across property types. So if you look at loans that paid off post-maturity, loans that were extended, loans that realized in losses, and some that are just unresolved, we see that for lodging, typically those tend to pay off most frequently after maturity, and they also have the lowest share that's unresolved. And then this contrasts with sectors like office or multifamily, where office tends to have the lowest rate to pay off past maturity, but also one of the highest rates of just unresolved loans. And multifamily is even higher than office with loans that are just unresolved. And I think there are a few reasons why these might still be unresolved. For office specifically, it could be uncertain valuations, macroeconomic uncertainty impacts all property types, or there could just be bottlenecks in deciding exactly what type of loan from which lender. And so this is something that we're looking to investigate a little further down the line. But if we look at maybe the lodging outcomes, these could be indicative of what might happen in other property types for unresolved loans. But it's my sense that this is probably an optimistic upper bound for what could happen in terms of loss rates in the other property types.
Yeah, it'll be interesting to see how these things finally get resolved. I know you mentioned we're going to do a deep dive analysis on examining the unresolved loans and seeing if there's any patterns or any insights that we can glean from that. But I mean, I think at some level, maybe I'm just simple, but the math just doesn't math for these folks. I mean, that's the challenge. Like nobody wants to take the write down. Nobody wants to wipe their investor equity out. They want to continue to try to, you know, kick the can, et cetera. At some point, to get like office as an example, 49% of those deals unresolved. My supposition is just it's just a value issue. Nobody wants to actually re-underwrite the loan at the new value and or force the issue. And so it'll be interesting to see what our additional research comes to. But I have a sneaking suspicion that that's what we're going to find out on some of these properties where the asset values are just depressed. I mean, lodging is, to your point, maybe the upper bound. But if you look at lodging performance over the last 5 years, RevPAR, ADR, all at all-time highs, occupancies in most major markets, all-time highs. And so there are some strong tailwinds for that sector broadly relative to these others. So it'll be interesting to see. This has been a really great series of reports. If you have not read the two reports, I would ask that you take a few minutes and download them and go through them. Rachel and Stephen have done a great job of digging through the data at a level that, most people don't have the ability to because they don't have access to the underlying data. So it's really great to see. Now, so like, we said we're going to do some additional digging on kind of the unresolved loans. But this, I think, is a great slide, Rachel, that kind of gives some perspective of just some of the timing of how this process actually plays itself out.
Yeah, to give a more of a forward-looking perspective on what might happen, just looking at this resolution timing dimension, it seems like as loans linger past the maturity, the resolution outcome becomes less favorable. So we see that the ones that pay off tend to pay off maybe 2 to 4 months after maturity, but as you get into 5 or 6 months, we might see more modifications or extensions. And then when we get close to more of the year mark, that's typically when some of these loans tend to result in losses. So we'll examine a few other dimensions and try to give a more specific prediction on what we think might happen. But just looking at the resolution timing dimension, it looks like longer it lingers, less favorable outcome.
I think that makes reasonable sense. We actually have a guest podcast episode that's going to come out in the next week or two where we actually talked to a workout specialist and had put a white paper out. We had provided some data that suggests that this plays out not just now, but this is kind of the trend from the GFC forward. The longer things linger, the worse the results are. So we did have a couple questions come in. So Tom, maybe you can take this first one. On the slide showing the real estate taxes as a percentage of revenue by MSA, are the changes more of a numerator or denominator effect? Do you have any thoughts on that?
So we touched on that a bit when we looked at the broad national numbers. I mean, personally, my understanding is that taxes as a line item have been increasing. I mean, if we look at taxes as a percentage of revenue, we can look at both of those metrics. Revenue has been relatively flat, again, and kind of growing in line with inflation, and taxes kind of grew as a disproportionate factor in the urban office environment. So I would personally attribute it more to taxes increasing than to revenue decreasing in the urban office environment.
Okay. And then on the maturity slides, are those just CMBS on these reports here, Rachel? CMBS, or do they include the CRE CLO data as well?
It's just CMBS.
Okay, just the CMBS. That's what I thought. Okay, so great. And so we did have another question come in. Yes, we are going to give you a copy of the recording with the slides for those that are in attendance today. So appreciate that. Okay, so highlight here. We need a sounder. I need to talk to Haley and the team. We need something that says Trepp Training Solution Sounder, so that I can do a quick ad read here. But basically, we have two 11-week asynchronous online courses that we started offering. One is very direct commercial real estate course, talks about just life cycle of the deal, financial modeling, underwriting fundamentals, market risk, financing structures. You take it online. It's 11 weeks, pre-recorded videos, quizzes, exams. Really cool class. You should check it out. Then we have a CMBS course that goes through deep dive of just CMBS more holistically. So history and foundation of the CMBS market, what the market structure is, differences in tranche and risk structures, calculations, etc. We are offering a $200 discount if you're an attendee of this webinar. You can use the code Labor Day 25 at checkout. You get $200 off. You get Trepp certified, put it on your LinkedIn, etc. I've had several people take the courses. Very strong and positive feedback for those that have. If you have a firm that might be interested in doing multiple people, we can definitely sit down and talk to you about a bulk pricing package for your firm. So if you need CEs or additional continuing ed, we'd love to sit down and talk with you and see how we can work something out. Okay, so back to the presentation here. So let's dive into the supply and demand in these high growth markets that really don't have a rent controlled component to them, right? So there's been no shortage of discussion, especially with the new mayor race in New York around rent control and what the impacts are and how much influence, if any, government should have on restricting rents, et cetera, et cetera. You're putting out a report here soon, Tom, that looks at, this good old-fashioned thing called supply and demand and just basic economic principle. So these are a couple of cities where we've highlighted there's not really any rent control or any rent restrictions. And what does your data tell us around permits, new units, and what's happened correspondingly to the actual rents in place?
Yeah, Lonnie, as we all well know, this is a topic on everyone's mind, especially, folks my age trying to, find housing that they could afford is tough in a lot of the cities where you want to be with all the jobs. But what we wanted to do was find examples of success without price controls. As you said, there's a lot of political focus right now on just how to make housing affordable. And the easy answer in a lot of people's minds is to, oh, well, the prices are too high and cap the prices. But in the long term, there's an ecosystem of supply and demand, as you said, that feeds into each other. And so, that is an interesting conversation to have at a qualitative level, but we got to get quantitative. That's kind of the whole point of our jobs. And so we've put together some of the data on what multifamily building permits per year per 10,000 residents. And this is going back to 2016 when I could find solid data. All publicly available data reported by the U.S. Census, as well as the relationship between our average rents and average incomes, again, reported by the U.S. Census. So what we found was, and we put out a report earlier this year looking at rent-regulated cities like New York, L.A., San Francisco, St. Paul, Minnesota, Portland, both Oregon and Maine, among a few others. And what we found was that the average rent burden in those rent-regulated cities, i.e. the proportion of rent to income, is about 32.15%, right? And that's kind of become standard in the country. It wasn't always the case, but people are now expected to spend about 30% of their gross income on rent. Now, that is not the case, however, in every high growth city. And so what we found is there's a few more that are going to go into the report, but the most notable ones were Austin, Nashville, and Tampa. This is where a lot of young people with white collar jobs have moved recently and have found a way to afford rental housing as a result of an abundance of supply. And what you see on the columns, the bars here on this chart, is the levels of permitting. And Austin, very, very cool city that has attracted a lot of young people, has built, in accordance with that, a ton of housing in proportion to the population growth. And as a result, you see the bars going up, and then you see the lines, which represent rent burden, going down. That is a successful relationship between supply and demand and pricing in our mind. And so it's important to note the wages in these places have also increased, right? So if you're attracting good jobs, you're attracting jobs in the tech, the finance, the media space. That does mean that wages are also increasing, but that is also has to be kept in proportion to the supply and to the pricing of rent. So what happens in a place like New York, LA, San Francisco, where the supply is constrained, and we'll look into a little bit more of the result of that data in the age of our housing stock in subsequent slides, is you have demand increase, but you have supply remain the same, and therefore prices increase. However, in these successful areas, rapid permitting, new supply, loosening of regulations to allow new supply to be constructed, changes in zoning regulations, changing in parking minimums, just for some examples of policy that have successfully facilitated the introduction of new supply, have managed to decrease prices in relation to income, so that people are spending 10 to 15% of their gross incomes on rent versus 30 to 35%.
So just a quick time check here for us. We have about 10 minutes left, and we still have a few slides to get through. This will be coming out in a report. So we've consolidated some of the results for the presentation today. So as Tom's mentioned, he's gone through, on the last slide, a couple of cities. On this slide, we'll have Tampa, Nashville, and Austin on the left, and then we have a few more on the right. In the report, we'll include the full list of cities, so you'll get the more detailed data. But for the presentation, we try to condense it to something that was a little bit more visually appealing, that we could talk through. So let's talk a little bit about the housing stock based on age. And so, you've got some perspective here around, what we're seeing from a supply perspective, decade over decade.
Right. Again, this is just our securitized set, so this is not necessarily representative of the whole market, but it is representative of this very important and very salient data set. And what you find is that the more restricted supply, markets have older supply. It's relatively straightforward. New York's obviously quite an outlier. It's the largest rental housing market, the largest city in the nation by far. So that kind of distorts the chart a bit. But even if you extract New York, the left side of the chart, meaning the older housing stock, is much more populated in the rent regulated markets than the high growth, on rent controlled cities, which have a lot more new housing stock, particularly Austin. I can't say enough about how good of a job Austin has done at introducing new supply and making it affordable to live there for all the young folks who have gone there searching for more space and still high paying jobs.
It's funny, the data would suggest that, but if you talk to someone that is from Austin, they would tell you that it's outrageously expensive, and that all these California and New York folks have brought relative affordability to Austin, which means it's unaffordable for locals. And I struggle with this at some level because it's all factually correct, but I feel for the developers that have built in those cities, right? So one of the downturns, it's great for the renter in this case, where the rents have come down because of the supply. It's difficult for the lender and the operator when there's basically nothing that restricts people from building an apartment complex directly across the street from you, et cetera. It makes for a very challenging market. We've seen Houston as another example of this, like over time, where it just doesn't see the price increases in value, et cetera. It doesn't have pricing power on the rental rate side because people just continue to add to the supply. So from a renter's perspective, it's incredible. We're seeing the supply and demand work like it's supposed to. From an owner operator perspective, it's a really tough market to be in if you're in Austin or Nashville today, because the factors of supply and demand don't work in your favor when there's an influx of new supply. So let's transition. This looks at, again, the median multifamily rents on a per unit basis across those markets. And you can kind of give us the takeaway here on the 10-year time horizon.
Yeah, I know, and they say in Austin that they want to keep Austin weird. That's hard to put on a chart, but we're trying to make the experience a little bit more understandable, for our audience. And I think it's interesting to look at the median rents and the securitized data set and show that that rents have increased, right? The rent level has, generally speaking, increased at, again, a rate in line with inflation. Our point in comparing these free market cities to others is just showing that it has increased in line with inflation and proportionate to income, as opposed to other cities where rent growth has grown significantly out of proportion with general inflation and with the inflation of income, meaning affordability as a metric has decreased in those other areas, and in these cities, the supply, demand, and price charts are much more balanced.
And so that'll transition us here just to a similar but different insight where you're looking at occupancy in those markets. So obviously the more supply constrained, they usually don't have an issue with occupancy. You mentioned New York. I mean, New York has been about 2% vacancy or 98% occupancy forever, which is why the prices continue to increase. With some of these more supply conscious, markets have seen challenges with some of their occupancy,
Yeah,
obviously.
anyone who's looking for an apartment in New York knows, you don't see bidding wars for rental units in the other cities, but you do in New York. Even without broker fees, it's still rough out here. But still, the occupancy markets in the occupancy levels in these more pro supply markets are still usually healthily in the 90s. We've seen some decreases, and particularly again, Austin introduced a lot of new units, but they're being absorbed. And yes, developer profits have probably taken a bit of a cut. But in the long term, that is a more healthy market with actual competition versus building moats and not allowing new supply to compete.
Yeah, agreed. I will say on this though that this is looking at physical occupancy, and so if you back out concessions and free rent, your economic occupancy in a lot of these markets are even, sub 90, which is challenging, right? So,
Good point.
however, kind of going back to Rachel's piece and some of the distress, and it's going to create opportunities for the next buyer that comes in and buys these properties at a discount and can reposition them. So, let's look briefly at our lodging and CapEx. So, this was something that we had talked about on the podcast at some length over the last couple of months. I've been a proponent saying that since COVID, hotels have deteriorated fairly rapidly. The revenues don't suggest this. ADR RevPAR does not suggest this, but if you actually physically walk the assets, some of these are 10 years into a cycle without having renovations because of COVID. And so Stephen went through and did a pretty nice deep dive on just CapEx spending for the sector broadly, and the takeaways were pretty interesting.
I agree. And as a power user of hotels, Lonnie, you know better than anyone, but the the quantifying this was an interesting task, and I love the way that Steven ended up putting this together. So basically, we see a proportion of kind of high, medium, and low investment in terms of CapEx at limited service hotels in particular. And it's important to note limited service hotels because I think the full service hotels, the kind of swankier, higher end hotels in prime locations with a good deal of amenities, have generally performed about the same as pre-COVID, if not better. Again, we see the top of the income spectrum really hasn't pulled back. They're the ones floating most of the consumer and services spending in the economy as a whole. But for the limited service, kind of broader middle class hotels, those did not make the same level of investments during lockdowns that they had in the past, and they've reverted back to previous levels before. But that means those dollars never got spent. So if we look at the impact of that 2020 more or less pause in CapEx, it decreases the overall quality of the stock, and we basically found a strong link between the delinquency of those limited service hotels following that decrease in CapEx investment.
Yep, and this slide will kind of walk us through that. And again, on each of these slides, we have the QR code if you want to get the blog.
Exactly. And that blog kind of walks through everything in a bit more exquisite detail. But again, limited service hotel delinquency leading the way. It's no surprise, especially again, as Rachel has spoken at great length about and explained in exquisite detail, maturity distress is the primary driver of these things, right? So if there's been an underinvestment in terms of CapEx and limited service hotel, when it comes due, it's going to be valued less. And that's going to qualify for lower loan proceeds. And in many cases, it will not be able to retire the outstanding principal balance.
It's really interesting. I know that Rachel's analysis earlier showed that hotels were resolving at the highest rate on a sector basis, but if I'm looking for where we're going to see the most distress over the next couple of years, my vote is going to lodging for the reasons that I talked about. Like these properties are just really tired. And if people actually underwrite the asset and not just the financials, you're going to have a really hard time um, keeping some of these courtyards as courtyards or keeping some of these other hotels at the current flag that they're at because they're just not nice enough. And so it'll be interesting to see how this plays itself out. We'll have more to come on this as it continues to evolve. So a couple of upcoming events, housekeeping items. We have a couple of conferences. I'm actually out in San Jose right now. I'm going to be doing a presentation tonight with the Northern California CCIM group. So if you're in San Jose area or surrounding market and you want to come out, shoot me an email or reach out and we'll get you the details on that. Love to say hi. We're going to be at the CREI Summit out in Palm Springs, California here in a couple weeks, September 10th through 12th. Haley's going to be on a panel talking about podcast guests, and I'm doing a presentation around data and how it can impact your business. We're going to be in the UK at the Opal European CLO Summit on the 7th of October. We're going to have a booth there. You stop by and say hi to our team. Rachel's going to be at a Empower, Educate, and Entertain Contractors, Closers, and Connections in New Jersey on the 15th. And then we'll be at our ABS East Conference in Miami the latter part of October, talking about our CMBS, CLO, and other Trepp products. So again, as always, we greatly appreciate you carving out an hour to spend with us. It's amazing how fast the months go. We'll look forward to putting out another event here in September. If you don't mind, please take the survey at the end of the presentation. If you have any suggestions, we're always open and enhancing or talking about topics that you find salient for your business. And continue to support us. We'll continue to put out our best efforts. So thank you again, and I hope everyone has a great holiday weekend. Thank you.